This introduction delves into the fundamental aspects of how contracts shape the Islamic finance landscape, exploring their importance in promoting financial practice consistent with the principles of equity, risk sharing, and social responsibility. Islamic microfinance can be directly related to Sustainable Development Goal 1 that seeks to guarantee that everyone has proper access to resources, services, and opportunities by 2030 and ends poverty in all of its form and expression. Islamic microfinance supports small-scale enterprises and individuals in need of financial help by using equity-based financing, profit and loss sharing agreements, and other Sharia-compliant procedures in place of conventional interest-based loans. Not only that, Islamic microfinance institutions can also empower the poor by providing savings accounts, microloans, and other financial instruments that help people become self-sufficient and end the cycle of poverty. In this video, we will be discussing about the purpose and effects of contract in Islamic microfinance. Some common types of contract used in Islamic microfinance include murabahah sale, ijarah, takaful, and musyarakah and mudarabah. The asset-based selling transaction known as murabahah, which is used to finance product required as working capital, is the most popular Sharia-compliant contract available. A murabahah sale needs to meet certain requirements in order to stay Sharia-compliant. Number 1, the commodity must be tangible. Number 2, the financier must own it before selling it. And number 3, the client must approve the buy and resale prices. In order for the transaction to be classified as Islamic, as opposed to a sale with concealed interest, the ijarah contract has to clearly state that the financier retains ownership of the item and is responsible for its upkeep. A sale contract in which the lease requires ownership of the commodity may come after an ijarah contract. Takaful is a collective insurance plan that is comparable to Islamic insurance. Last but not least, musyarakah and mudarabah, which are also known as profit and loss sharing. For your information, in Islamic contract terms, riba means an unjust charge on borrowed capital to be paid by the borrower. Other than that, Islamic contracts focus on risk and return sharing rather than the conventional ones that are profit-based. As Sharia prohibits riba as a way of earning money, sharing risk and reward, also known as mudarabah, is permissible in Islamic contracts. Islamic contracts' purpose is also known to be created to avoid gharar. Avoidance of gharar is necessary as Islamic contracts wants to protect both parties from disputes caused by the ambiguity of the contract and from hedging and insuring. Insuring means paying a premium to avoid losses without giving up gains. When you hedge, you eliminate the risk of loss by giving up the potential for gain. When you insure, you pay a premium to eliminate the risk of loss and retain the potential for gain. Islamic contracts, derived from Sharia principles, differ significantly from commonly used conventional contracts practiced in the secular world. Although both aim to define legal obligations between parties, the expected impact and underlying principles will be different. Prohibiting excessive uncertainty, which is also known as gharar in contract, ensures that risk is distributed fairly between the parties. While Islamic contracts prioritize consideration of ethics, justice, and risk sharing according to Sharia principles, conventional contracts focus on legal enforceability and individual autonomy.
How Islamic contract contributing to the economy? Money is not considered as an asset in the sense of Sharia law, but rather a means of determining worth. It does not permit receipt and payment of riba, gharar, maisir, short sales, or financing activities that it considers harmful to society. Banks cannot make money from interest on loans. Instead, their revenue must originate from the success or failure of the businesses. One of the Islamic contracts that contribute to the economy is suku. Suku had grown in popularity as a debt instrument in the global capital markets throughout the past 10 years. Suku, also known as Islamic bonds, are securities that may be traded just like conventional bonds. They represent ownership of financial certificates of assets or a pool of underlying assets. The right to collect income from the issuer's business can also be granted to the holders of suku. Suku follow and are compliant with Sharia, the body of Islamic law. Three key principles that suku has to comply to be officially Sharia compliant. First, riba. Interest, whether fixed, floating, simple, or compound interest, is prohibited because no one should be able to earn an income from money alone. Second, gharar. Removing excessive risk or uncertainty that may void a transaction or contract, particularly with regard to future events and qualities of goods. Third, maisir. It is forbidden for one party to gain significantly at the expense of another. This includes borrowing money to speculate on currency movements or similar activities. How Islamic microfinance helps in alleviating poverty. Alleviating poverty take numerous measures which are full inclusivity for the finance access for non-bankable clients, excluding collateral or guarantor for the borrower to facilitate the process, and reducing the dependency of the poor on charity to encourage the initiative. In ensuring the needs for the financial institutions, they can also set up some conditions to ensure their needs, like the term to form a group before applying for a loan. There are several Islamic microfinance instruments that can be used to help people in financing, which are Mudarabah. Mudarabah is a type of contract where the capital provider or microfinance institution and small entrepreneur become a partner. The profits gained will be shared between parties. Meanwhile, the loss will be borne by the capital provider entirely. The profit sharing ratio is determined according to the agreement by both parties on a ratio basis. Basically, after the full settlement has been made, the entrepreneur will own the business solely. Musyarakah. In this scheme, microfinance institutions will join as a partner with micro-entrepreneurs. The profit will be shared based on agreement ratio, and the loss will be borne based on capital contribution ratio. The concept of diminishing partnership or musyarakah mutanakisah could be the most suitable technique for the microfinance. In the case of musyarakah mutanakisah, the entrepreneur will pay a certain amount by installment to the capital provider until the ownership ratio of capital by the capital provider diminishes and increases the ownership ratio of the entrepreneur. Upon the full settlement, the entrepreneur will be the sole owner of the assets. Murabaha. Murabaha is a type of a contract where microfinance institutions purchase assets or business equipment first and then sell the asset to the entrepreneurs at a markup price. The entrepreneur can purchase the asset on installment basis, and the finance institution will become the owner of the asset until full payment has been made. Ijarah. Ijarah is basically known as a long-term contract of rental subject to specified conditions as prescribed by the Sharia. The lessor owns the assets as well as responsible to maintain and repair the assets for the mechanical default, excluding wear and tear. The microfinance institutions needs to purchase the assets first before promoting and leasing the assets to the clients. Basically, it is the same way people conduct in the contemporary leasing contract. Qardul Hasan. This is the most simple concept of loan that can be advanced, which is Qardul Hasan or interest-free loan. Since Islam forbids the interest, the microfinance institution can only provide loans without expecting any premium. Any micro-entrepreneurs who need immediate cash to start up a business may consider this option. The microfinance institutions may charge their clients with a fee for the service provided. The repayment process can be done on installment for an agreed period between parties. How has the Islamic contract Mudarabah been developed? The word Mudarabah comes from ad-darbi al-arb, and also known as silent partnership, that involves Rabbul Mal and the Mudarib. Mudarabah has different terms from different fiqh scholars. According to Imam Hanafi and Hanbali, they call as Muqarradah, and Imam Maliki and Shafi'i, they use Qirat terms as Mudarabah. The word of Muqarradah and Qirat came from hadith, which narrated by Sunnah Ibn Majah, reported by Salih ibn Shu'aib from his father. He said, Rasulullah sallallahu alaihi wasallam once said, there are three blessed things: deferred sale, muqarradah, and mixing barley and wheat, and not for sale. There are elements of mudarabah that need to be understood in terms of its legitimacy, pillars, and conditions. First, the legitimacy of mudarabah contract is based on revealed knowledge of Quran and Sunnah. Second, the pillars of mudarabah is sirah, or offer and acceptance. Third, the subject matter and the conditions of mudarabah. In a profit-sharing contract, there is no guarantee of capital because of the concept of al-ghum bil-ghum. which means no reward without risk. The profit of the investment of the capital is divided by the ratio agreed in the contract, and for the losses, the Rabbul Mal only incurs loss of capital provided, and the Mudarib will be liable for their losses in time, effort, and any negligence or moral hazard. In Imam Shafi'i's view, the dissolution of the partnership can occur if one party dies. Islamic contracts are legal agreements that adhere to Sharia principles and promote equitable resource distribution. They offer Sharia-compliant financing options, free from riba, which can lead to economic instability. These contracts focus on risk and return sharing, benefiting all parties involved, and avoid gharar to protect social welfare. Islamic and conventional contracts differ significantly in their principles. Islamic contracts are based on Sharia law derived from the Quran and Hadith and prohibit interest. They emphasize mutual understanding, uncertainty avoidance, and risk sharing. Conventional contracts, on the other hand, are based on legality and enforceability, include interest, and focus on individual autonomy. To combat poverty, measures such as full inclusivity for all client stages and facilitating microfinancing to the poor by excluding collateral or guaranteed terms have been suggested. Islamic microfinance instruments like Mudarabah, Musyarakah, Murabaha, Ijarah, and Qardul Hasan can potentially improve living conditions.